G'day, Dennis here. Been getting questions from my students regarding why the market's going up. There are a lot of people out there who are asking that question. And so I thought I'd put forward what my research suggests. Here's a little slide set that I put together some years ago, and I thought you might be interested. Thanks for watching. If we take the Dow and the longer term stock prices from earlier than the beginning of the Dow in 1896, and start from 1932, the Great Depression low, and repeatedly subtract 18 years, let's see what we get. 1932 minus 18 takes us to 1914. Oh, well, stuff me, look at that. A significant low. Let's do that again. 1914 minus 18 years, 1896. Start of the Dow. Oh, look at that. A significant plunge into 1896 and a significant bounce out. Back to 1878. Missed by a year. Would you give me that? Certainly plunge and bounce into 1877. Close, not bad across 18 years. 1 year out of 18 years. Let's do it again. 1860. Missed by 3 years. Maybe this is all falling over. Well, it's very interesting when you work with cycles and you get something like this double bottom. What we have is a price low in October of 1857, but then there is another low that I call a time low just a little bit later. So compared to 1860, that second time low is not far off. Another 18 years back, 1842. Now on this data set, it says 1843. I have seen data sets where this low is actually 1842. And that drop is huge. Do the percentages for yourself. From 36.6 at the high to 9.7 at the low. But missed by a year based on this data set. Notice 1932 to 1842 is 89 years, which is mighty close to 90 years. And it's on the harmonic of 5. 5 lots of 18 years. Well, maybe all that was just a fluke. Let's see. Continuing on, 1842 minus 18 gives us 1824. Now that low is not significant. Yes, there's a low there. Okay, I'll give you this one. Let's go another 18 years. 1806. There it is, 1807. Significant plunge and bounce this time. Let's go again. 1788. Now in this case, we get 1789, missed by a year, and it's fair comment to say that we have the left-hand edge problem where we're not absolutely certain that there was plunge into this and that this in fact was a really significant low. What we can say based on this data is there was certainly bounce out the other side. Well, that's always interesting going back into history, but let's go forward. Again, starting at the Great Depression low of 1932 and repeatedly adding 18 years. Now, you will notice that what I've been doing is a mathematical addition. I haven't been shifting the anchors. So it's just a mathematical exercise of adding 18 years. Here we go, 1932 plus 18 gives us 1950. Well, stuff me, look at that. 1949, missed by a year. Go again, 1968. Starting to get into living memory here. Not bad. And those of you who are really interested in this will start to say, oh, but what about 1974? That was a bigger low. Well, let's just continue this on, add on 18. 1986, that's the 1987 crash. Again, missed by a year. Add 18, 2004. Now, in 2004, there wasn't a low. However, if we go back to the price low, it was 2002, so missed by 2 years. However, in 2003, there was another one of these time lows, as I call them. And the reason that I utilise the concept of time lows is because the cycles point to 2003 and they forecast better out of 2003. So missed by 1 or 2 years. Here we go. The interesting one, add another 18 years. Well, stuff me, look at that. 2022. That's the here and now. And the reason that I think that the market's been going up since the equinox of 2020, the 23rd of March 2020, is because it is believably a 90-year low out of 1932. So for those people out there who can't make sense of why the market's going up, perhaps you'd like to reflect on this research. More than happy for you to shoot me questions. Thanks for watching.